Okay, we come next to variable interest debt. So remember we were saying that the bullet bond is a fixed interest rate bond, but now interest is no longer fixed, but variable. In this case, certain bonds and loans feature variable interest payments determined by a market reference rate. So in the CFA curriculum, they list it out as a market reference rate. I always understand this as the base rate along with a credit spread. So you have the base, which is the government rate, and you have a margin. You add on top of that a credit spread, so you result in a higher interest rate for the debtor. Financial institutions, particularly banks, they favor floating rate loan assets as they align with the variable rate liabilities, such as deposits. Liability matching. So what they do is that they loan from depositors at a short-term rate, and they lend it out long-term to borrowers. Because they borrow short-term, which means they do not assign a fixed interest rate. So every few months, the interest rate would change, right? If it's like a short-term loan on the depositor side, or it's even a daily rate for most commercial bank. In that case, the side that they lend it out, if it's a fixed rate, that means that they will have an interest rate risk because they will not know what is the interest rate that they owe to the depositors in the future because it's variable. So they would prefer a floating rate loan. In the future, when we talk about interest rates swaps, we can see how we can swap floating into a fixed rate, because even if banks favor a floating rate loan, they might not actually get a floating rate loan, as in they cannot lend it out at a floating rate. So they can actually swap it to a floating rate, so to match their liability, which is the money they owe the depositors. But these different scenarios we will touch on in the future when we cover swaps. But for now, we just focus on floating rate bonds. So loans or floating rate notes, FRNs, are appealing to investors anticipating increasing interest rate, as they offer the potential for higher return in such an environment. So you can see, okay, so why would investor want a floating rate note? It's because they envision that the interest rate in the future would rise, so that they will collect more interest rate in the future, right? So this is a part that, so they will buy the bonds, they will lend it out to the issuer at a floating rate interest rate, is what it's saying here. If the interest rate were to go down, the variable coupon rate that they'll get will go down as well, which means that there's a risk that is involved. So which is why if you get a fixed rate, you are indirectly saying that you believe that the interest rate will go down, so that you will fix at a rate that is fixed at the outset. And we will also show how in the future, how the fixed rate is actually calculated. It's basically you can think of it as the average rate in the yield curve for the period of time, because how they actually derive the fixed rate of the bond is also by how they calculate it from the market, right? We have this FRN coupon, you have the market reference rate, and you just add a credit spread on top of it. In addition to adjusting cash flows based on changes in the market reference rate, other mechanisms exist which can either predetermine or triggered by specific events. So what are the predetermined adjustments? It involves scheduled increases in bond coupons at specified dates, known as step-up bonds. These are more exotic bonds in the sense that it's no longer a plain vanilla bond. And it means that your coupon rate would in fact increases as time progresses. So these are the predetermined adjustments. So it falls under the variable interest category because your bond rates are different. But then the step-up amount is known So you know that even though it changes, but it's still fixed in the sense that you know how much is the fixed part is predetermined. These bonds aim to safeguard investors against rising rates and may incentivize issuers to utilize contingency provisions. So this is the part that, okay, for example, you might be worried that interest rate were to go up. And if I fix the rate now, I would prefer if you would step it up. So the first part is lower, and as time progresses, you will increase. But in terms of bond computation, you can average it out and then have this one fixed interest, fixed coupon rate throughout the term of the bond. But maybe for the company, they will prefer this because initially they pay lower interest rate and it only increases as time progresses, which ideally they will have, because of various reasons for the company, they might not want to have cash flow issues at the beginning, and they will only increase the payments at the end, which is like a kind of delay paying of the interest. And also, event-based adjustments occur in response to specific occurrences, such as deterioration in an issuer's credit quality. This is the part on the contingency provisions that there's in the previous point. Based on certain events happening, you might result in an event where you can call or put the bond to the issuer. So coupon in cases of the contingency provision may increase to compensate investors for heightened risk. So in terms of the options on bond, so that is a part where you have contingency event, right? But in this case, rather than you put the bond back to the issuer, you increase the coupon payment instead. In this case, to protect them, they will actually increase the coupon. Because from a lender's perspective, all I care about is whether I get the money back. But this might actually accelerate the company's demise. But as long as the company doesn't go bankrupt and default on its bond payments, from the bond holders, as long as I get the money back, it's good enough. By increasing the coupon rate, you might actually accelerate the demise of the company. So you need to balance the situation, because at the end, if the company were to go bankrupt, you will not get your money back. So this practice is common in leverage loans or loans with lower credit quality issuers. This is the cases where you come to a point where you charge really very high interest rate for these loans because the default rate is high. So the lender has already accounted for the fact that they might not get their money back, which is why you have very high interest rate or provision that result in interest rate to be very high. So this coupon adjustment may also be tied to financial covenants or credit ratings as seen in credit-linked notes. Okay, so we come to the credit-linked notes example. So based on the issuer's total leverage ratio at the end of each quarter, so based on this particular scenarios, if remember this, okay, so this is the credit spread. So your credit spread will go up if your TLR ratio goes up. So for example, if it's above a certain level, like 3.5 in this case, your credit spread will be higher. And if it's like lower, it will be lower. So 250 basis points, that means 2.5% spread on top of the MRR, the market reference rate. And for people who is interested, total leverage ratio just means that total debt divided by the EBITDA, the earnings before interest, tax, depreciation, and amortization. The reason why you exclude the interest, taxes, depreciation, and amortization because you want to come up with the amount of the net income adjusting. You add all this back. You want to know the net income, the revenue that you have that you are able to pay off the debt holders. So before you pay off the interest, any taxes, because at the end your tax is computed after you pay off the interest. So all these are added back, and depreciation and amortization are not a cash component. We will talk more about this in the financial accounting part of the CFA, where this will become clearer.